This webinar was born out of really two trips. One in which where Shay, myself, and a few members of the Fractal team did hosted events in Peoria and Cedar Rapids. We probably had about total, what, maybe 60, 65
Yeah.
farms across the two. And just some really fantastic discussion from other folks just from the farms, sharing some of the things that Shay has seen on the AgView side that we've seen on the Fractal side. And so we wanted to distill that plus another 30 or 40 farm visits that we've each probably had in those 2, 3 week period and just get really tactical. So this is going to be more interactive. It's not going to be super polished. We're trying to just get out there and replicate some of those conversations, especially for folks that weren't able to make those. Maybe before we dive in, Shay, just in case not everybody knows you, I know you're on every podcast in agriculture because apparently you like that sort of thing. You want to introduce yourself?
Yeah, Shay Folk with AgView Solutions. We work with farm operations and ag businesses across the United States and Canada, helping with things like cost of production and business management decision making. So when it comes to growth opportunities, that's an area where we are very aligned with Fractal's outlook on how do you take on these growth opportunities because they're massive. They're no longer these small pieces that we're trying to bite off. And how do you assess that? And it takes some diligence, it takes some tools, it takes some having the right people in the room to have those discussions. So looking forward to today's conversation.
Yeah, thanks, Shay. And I'm Ben Gordon, CEO, co-founder of Fractal. We're a farm capital partner where we keep farmers in control and minority invest on land that they own so they can get new sources of capital to complement what they have from the bank to grow. So essentially allow you to go a lot further with the cash flows that you have overall. And we can get into that as questions come in. But I think maybe where we want to start off and where we spent a decent amount of time was just really, build some of that context. So when we talk about the last 10, 15, 20 years, like what have you seen, Shay? And just like what were some of the learnings that we got, frankly, from the folks we were talking to on like what have been the big levers? Because this isn't the first time there's been a downturn. And while history doesn't always repeat, it often rhymes. So let's try to synthesize a couple of those things together.
Yeah, and if Harrison wants to go to the next slide here, I think the key message that you guys have is this growth that we have occurs in cycles, and it's not necessarily predictable, but you can look at the environment that you're in and say, where are we today for the decisions that we're making as you move forward? So if you want to run through this, Ben, I'll dive into maybe what we've seen over the last 10 years.
Yeah, I mean, I think overall, it's. I'm going to say some things that are going to sound really, really simple, but we don't always act on the simplicity of those assumptions. First one is the data is pretty darn clear that appreciation lags operating profits. In other words, the operating profits come first, and then you see the land appreciation. I think if you actually look at most assets that are capital expenditures in agriculture, you'd see some similar relationship, and that shouldn't be a surprise to us. When commodity prices and operating profits are high, there's more buyers. That drives up the value of what is typically a pretty scarce asset. Even when you think about things like tile projects or grain storage projects, you see availability and expense higher at the top of the cycle versus what you can often get now. There are impacts of interest rates, obviously, like this is still a financial asset, but given the low amount of leverage, you actually don't see relative to other asset classes really as much of an impact on anything other than operating profits. So what is the so what? The first so what of it is to be able to seize the bushels, the nominal value, the more scale when things hit up, you need to be ahead of the curve. The second one is if you're able to buy assets when the cycle is down, you are going to get a better entry value. Now, I understand how hard that is, and that's what we're going to talk about because it's really, really easy for Warren Buffett to say, "Hey, be greedy when others are fearful." When he's sitting on, 2 to 7 billion in cash and ready to go rescue Goldman Sachs. That is not the position all of us are in. But some parts of that concept hopefully can translate. And the folks that are able, by either just the situation and sometimes luck, but more often where luck meets planning and opportunity meets planning, that's where we're able to give that extra little kickstart.
Yeah, and I would say a very practical example for those of you that are farm operations calling in today to think about uh, when you look back 3 years ago, 2021, 2022, all sorts of issues. There was high profitability in farm operations in that 2022 and or early 2023 period, so 21, 22, and then into the beginning part of 2023. And we saw an exponential increase along with COVID pressures on supply and demand and things like equipment and trucks. Now we're sitting here today, Ben, in 2025, and we've heard from multiple operations and multiple people on the equipment side that there's great opportunities to purchase late model equipment to the tune of the opportunities we haven't seen since 2014, 2015, 2016. So how do you take advantage of that? Likewise, a perfect example, we're buying a semi truck. We had bought one in 2022, basically the exact same model or exact same truck, 1 year newer, is exactly half the cost today in 2025 as it was in 2022. So I wanted to emphasize that from the nominal pressure that you said, it's not just the commodity price, it's the influence that that market environment has on everything else that you do in your farm operation. So Harrison, if you go to the next slide here, the examples that we're going to talk about is during that 2019 to 2020 time period, and give or take a few years on either side. The question that I had for you on this slide, though, Ben, is when we look at these land prices, we're going to have some pretty stark examples of what that appreciation has done here over the last, call it 25 years, but even further back from a historical standpoint. Is land truly a linear outlook on what the valuation is going to do over time, or is it parabolic? And what I mean by that is, when you take some of these time periods, you have exponential growth in what that land cost has done. Look, 2010 to 2013, there was huge appreciation in land values there. So what do you think? Linear, parabolic?
I mean, I think it's your commodity market cycle, right? But it's going to be more and more volatile because I think commodity markets will become more and more volatile. But the difference in land between commodity markets is you have the safety net that protects the downside of land and low amounts of leverage, but you still have some of the upside, not quite as much, obviously, of commodities. And so that's the bet, frankly, why investors get really excited about it, because you're able to capture those big jumps while still having the security and the consistency down there. Now, you look at the end of that 2024, that's the first time we've seen it really go down since, 2012. But that's also where a lot of those opportunities sit, and we can talk more about that when we talk about just kind of the right strategy going forward.
Bit of a loaded question there, but essentially you got these run ups and then you have plateaus, and that's maybe your opportunity. It doesn't even necessarily have to be a dip, but what does that look like moving forward? So Harrison will advance through here and go ahead and pull up the 2019 operation, the first set of five there. So the first example I wanted to look through, there's three examples we're going to run through today, and these are clients that we've worked with. In 2019, we had a farm operation that was operating on 3,600 acres, and they just had a mess that was going on in their business. So we want to look at what are your opportunities that exist today to help give you an advantage as you move into the next cycle or preparing for whenever this next cycle comes around. We're in it today, but how long is it going to last? So this operation in particular, they had a lack of transition clarity. They needed to make some investment in infrastructure. They had a loose collaboration that maybe wasn't going as well as it needed to. They needed to update some equipment, and their team was kind of all over the board. And I think that's what a lot of people face, Ben, is it's not just one thing that you need to do. If we can wave a magic wand and say, these are the assets that are going to print cash for us, I'm going to put $1 in and get $1.20 out. Everybody on this call would do that, but it's the complexity of these issues that builds into it. Fast forward to today, they implemented some of that business structure as we move into 2026. So 2019, they got a transition plan in place. 2020, they had an opportunity to borrow and refinance at all-time lows. They did a massive machinery update in 2021, right before we saw some of the massive price increases. They hired a CFO and a full-time office staff person in 22. They were then able to hire two full-time employees. And in 2024 and 2025, they had these leaps that went from 3,600 to 4,500 acres. And then in 2025, they had an operation to go, or they had an opportunity to go from 4,500 acres to 5,500 acres. And one of the examples we're going to talk about later today is adding 30, 40, 50% to your operation. And what does that do to your bottom line? What impact does that have from a margin contribution, from a purchasing standpoint? They were able to absorb those opportunities because they got their house in order. So when you look at the complexities that go on in a farm operation, Ben, you got to make sure that you don't just have one aspect of your business in order. The capital is probably the biggest part of it, but having capital and then looking to grow when you don't have your house as it should be is the potential for a massive mistake. So I don't know if you had any questions after that, but just kind of
Yeah,
a
so you're saying to the capital guy that just like you don't run a business just on a spreadsheet. Got it.
no. It would be really great if that's all it took, but unfortunately, you get these silly little things called people involved, and that has an issue.
Yeah, I think the biggest thing when we were talking about this farm is like how integrated the whole strategy was. Because I think it would have been a lot harder for them to feel good about bringing on the CFO and the office staff and those employees without growth, right? But they
Mhm.
had to be ready to actually go take that growth. And I think this is where a lot of people get into analysis paralysis, or they're just like not willing to pull that trigger, especially when times are tight. And like I'm not making a values judgment on there. Like I've done the same thing in plenty of things in my career on where that's gone, but it's seen this actually play out where you have that integrated strategy to make that next step, where you have a little bit of that forward thinking, even if it's not all perfectly laid out because opportunities come up.
And what I would say on this is look at the growth in this last 2 years. What does that look like moving forward? So one of the analogies that we make here is like a growth snowball, or when you're making it. If you remember, Ben, I don't know if you had snow in North Dakota when you were growing up, or if you got snow out there in San Francisco ever. But when you look at making a snowman, you have that snow packing up on the outside, and I would hazard to guess that this particular operation may go from 5,500 to 8,000 acres over the next 5 years because they have the systems and equipment in place to do so. And I think that's really where the capital piece comes in, is how do you ensure that you're leveraging that to take advantage of the opportunities for growth moving forward?
All right, so going from 3,600 to the 5,500 like that, and potentially 8,000, that's a huge jump. That might look a little intimidating. Let's maybe go to the next one where it's a little bit less chunky, but still put it in the same context. And just as a reminder for everyone, there's a Q&A feature at the bottom. Ask us questions as we go through. We're going to get a little bit more into a kind of an interactive exercise here shortly, but we're just trying to build a little bit of that context.
So the second opportunity that we've seen one of our clients do is they had a chance about 90 miles away from their home base. They were farming 3,800, 4,000 acres to pick up 640 acres. Now, 320 of that was a purchase, but then the adjacent 320 on that section they were able to rent from the sister of the purchase opportunity. So 640 acres, 90 miles away, that was about a 20% acreage increase for them. And I think a lot of you that are on this call think, well, that's not only is that a big bite to take, but what about that distance? How do you handle that? And Ben, you and I have talked there's a lot of opportunity for this exact thing, because if you're in a pocket that is heavily owned, or you have other really good farm operations around you, logistically you can make it work. It's just a different management strategy. And so when you fast forward to 2025, what impact did that have on their operation? Harrison, if you want to pull that up. So they were able to refinance that initial purchase. They have it on a 5 year arm. They were able to refinance at an all-time low. And then they were actually able, because of that refinancing, to lock in a multi-year line of credit back when we were looking at like 2-3% interest rates. And think of the impact that that had 21, 22, 23 for their operating, because they had the equity into that land from 9 years of payments into it. It also allowed them a little extra cash flow to hire a key mechanic into their operation that worked on both the farm equipment, and then they had some trucking going on as well. So it spread out risk and gave them new market opportunities from a geographic standpoint. And that's something that I think we maybe get some backyarditis on. We say, well, why, I'm farming in Marshall County, Illinois. Why would I want to go down to Sangamon County or McLean County or whatever else? Well, you're a different county. You have different weather patterns. You have different insurance risks. So there's a lot to think about that. And then what they were able to do is they've had a massive balance sheet and equity gain in the meantime over that last 9 years, because when you think back to that first chart we showed, they had huge land value appreciation. And I think we're maybe sitting in an environment today to have another question of, or another opportunity to take advantage of that. So Ben, it
Yeah,
is a maybe a smaller chunk, but
But I mean, like 2016 probably didn't feel like that great of a time to be ready to go take a huge bite at the apple on it, which I think is
Right?
that's the other thing. It's always easy to look back with rose-colored glasses, but like this probably was a little uncomfortable for our friend here.
So, I mean, whether it's 2016 or whether it's 2007, where are you at in that cycle? How do you evaluate? I can't predict the future,
Yep.
but there are indicators that show maybe where you're at. And I think the bigger message here, Ben, and for everybody listening is you have to in place to assess these opportunities. We have people that either come to us and say, there's no opportunities out there, or there are these opportunities, but how do I assess them? So you have to have some tools in place. You have to have some exterior perspective, and you have to legitimately put a plan and say, if I were to do this, then what? How does this impact my operation? How does it impact my bottom line? And I think that's where a lot of us are guilty of falling short of are we actually going in and assessing these opportunities to the level that we need to be responsible business people.
Now, let's keep rolling.
Okay. Last one that we got here. So grain handling. I I'll keep this short. Really, what I want to say is just ensuring that you analyze what this looks like. So Harrison, advance to the far side. When you look at drying, storage, and the shrink that goes in versus what the co-op or what the elevator is charging you, it's a harvest efficiency tool. But you can take drying costs for about 60% of what it would cost you at the elevator. Your storage cost is cheaper. Shrink, a 1.4 versus a 1.25 shrink for what you would have in your own farmer operation. And then essentially that harvest efficiency. The guys that have put up grain storage over the last 7 years, but even over the last 2 decades, I mean, they're coming out 100, $150 an acre a head just through simple math.
Yeah, I think this is maybe I mean, really all of these examples we'll see, but especially the last two, like these aren't just like growth or investment or just scale opportunities. It's this combination of how are you actually through growth improving your margins. And so it's both defensive in the downturn and offensive when that thing turns. I think what a lot of people get allergic to is growth for growth's sake. There was the folks especially. I just remember like following early egg Twitter and like 2010 on like when I was deployed, just talking to farmers randomly, and like some of these folks were just grow, 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 grow. It's like no, it's like what is the discipline growth and are you losing per acre profitability with every additional acre or are you gaining it? And like that, just like sitting back in fundamentals on a project level and at your overall operation across those three examples is like one of the just big caveats that I think is super important.
Yeah, and I don't know if, some of those operations might have just gotten lucky when they had growth for growth's sake because of the market timing. And, sometimes it is better to be lucky than good, but for most people on this call, I'd rather, you take the outlook to match that opportunity with preparation to create that luck.
Cool. So, Harrison, let's put this into some context. Let's go to the next slide. This is just a way that we think about, frankly, how really, both the operational efficiency and growth in terms of like assets and where that goes impact cash flows and essentially just wealth generation. Maybe a couple of assumptions that I want to share when we come in here. We believe farming and just like we talked about this again with 70 to 90 farms over the last couple of weeks. And I don't think I got a single big disagreement on this. Farming is getting a hell of a lot more competitive, and we think that is going to accelerate with scale. It used to be, one or two large-scale operators, they'd set kind of the marginal rent, and then, you had a lot of rental relationships that were not really open market and where they were at, and, there wasn't that much of a procurement difference. Today, that's not really the world that we think that we're living in and increasingly not going to. Shay, what do you think the just procurement alone delta per acre is probably for a central Iowa farmer?
Yeah, some of you have heard this number, anywhere from 150 to $300 an acre on procurement or on the back end, your actual marketing. And I had someone reach out to me and say, "Well, how do you justify that number, or where are the specifics on that?" And we'll run through an example of what that looks like, but it's real dollars.
Yeah. And so essentially, like to be competitive, you are going to have to we're in a commodity industry. You're either going to have to be a low cost provider, of which scale is one of the levers if you have the strong fundamentals starting with agronomy. Let's always say that we love our agronomy, or you have to find a niche. You have to get off the commodity train. Like those are really the two options that the market are kind of giving us. Scale on the or I'm sorry, yeah, scale in terms of low cost is one of the biggest levers. So then how do we actually get to scale and how do we improve it? First off, if you looked at Shay's examples, if you talk to a lot of the things that they talk about at AgView, or just most of the lessons that are probably on, if you look at your own operation where you've seen big improvements, it's going to be operational efficiency to start to expand that margin. And a lot of the farms that we work with, excuse me, have kind of some secret sauce. It's, how do you take Class B ground of a certain type and get it to perform like Class A ground? How do you integrate livestock in a particular way? Like, what is your little playbook that allows you to get that extra little edge? The question really becomes is how do I scale that edge given just some financial realities? And so that's what I want to just talk through here and like what it looks like. So if we start with, a growth opportunity, essentially I have that 240 acres or that 500 acres that's chunking up. I have with in today's world, I have to either pledge collateral or I need to put a big down payment down on that. And then I'm still going to have the debt drag or sorry, the cash drag from debt. But that's how I get those assets. And those assets, after I purchase them, should be able to not just allow me to expand efficiency, but eventually will also appreciate and allow me to access more debt. Makes sense, right? The bigger problem with this model is that if we combine this with the chart that we showed before, it means we're often waiting for that appreciation bump to be able to access more growth, which means that we have to wait on essentially those growth opportunities for when everyone else has that. And that's not a great way to outcompete if you believe that competition is increasing. And so while this looks pretty darn simple in terms of, you wrap your head through it, what we're really talking about is investable cash flows and keeping those cash flows so you can fund an expansion of your operating business to make that more and more efficient while also protecting and growing that real estate business. Maybe the last thing I'll kind of say on this is keeping control and security as we get to scale is really, really important. So that way you're able to control enough of your own destiny. And so, what you're going to see as we kind of walk through the exercise is like we love rented acres for farms and where they fit when they're high security or you're risk managing maybe lower security rented acres. What do I mean by that? If you have a relationship or hopefully a contract, that is a much more secure asset base than renting to a traditional investor who might just sell because they're reallocating their portfolio, even if you have a great relationship with that farm manager. And then you go backwards on the scale game and you have fixed costs that don't match on this. And so this is really just like our fundamental framework of like how we think and really how we built the Fractal product to accelerate this. But really it comes down to how do you take the secret sauce that increase operational efficiency and then just scale that. So Shay said it before, I put $1 in, I get $1.20 out, and that keeps trending. Shay, what did I miss on this? We've talked about this a bunch.
No, I think, what efficiencies do you maximize first? And there's opportunities, as you said, on owned and rented acres to grow. And then we're going to look at the equipment, it's the infrastructure, it's the people, but you have to have the flywheel going in motion here in order to make that happen. And where do you start and how do you get that immediate injection is kind of the point here that we want to make.
And we'll get into some math on this, but maybe before we kind of go through this exercise, Harrison, you want to pop up the responses? I want to see how many folks went and kind of took Shay's excuse route.
You can throw things at me virtually if you're mad at how I asked the question on what was your excuse for why you're not growing, or what's your reason for why you're not growing?
Oh,
You see those results.
we do not. All right, we'll keep rolling. If you can see them on your back end, Harrison, maybe we'll have you do a little bit of a summary for us.
Yeah, sounds good. Let's keep rolling.
Sounds all right. So what we're going to go through now and kind of like where we want the meat of this thing to be is really just like a process that we've kind of gone through with a bunch of farms. Shay and I have done this kind of together with some other folks. We kind of did this even in some group settings. And this is just something that we often do when we're with our farms, just to look at, hey, where are they going and where is the capital need? Structure that we really start with is one, what is the lowest hanging fruit that's out there? And like, are you able to fund those projects? So when we say kind of field level margin, like tile, if you are missing, a field that you would normally tile because you think cash is tight, That is the best investment you can often make in many geographies out there. Like you shouldn't be holding back on that. And we need to find a way to get that because you're leaving margin on the table. The second big one is just mixed costs, so labor and equipment. So how many acres could you add with that same labor and equipment? Like this is where we often find the most low-hanging fruit out there in operations. Shay, I don't know if you agree, disagree, where that fits.
Yeah, absolutely. The equipment has to be maximized from an efficiency standpoint because you're paying for it whether you use it or not. And that working capital, it's just simple math. You take the same amount of working capital, distribute it over more acres or more usage, you gain efficiencies there. And I think as we look at scale from, mid-size to maybe slightly larger or into a larger scale operation, those equipment efficiencies are massive.
And oftentimes, so as we're scaling across those equipment efficiencies, then we don't want to lose the playbook. So Shay shared the grain storage example. It might be grain storage and drying capacity as you grow, or as you want to be able to, protect kind of your pricing position and where that moves and not have to deal with harvest logistics. Maybe in a year where, where I'm from a North Dakota basis is, if you can even deliver, is not so pretty right now and where that fits. Similarly, it could be other infrastructure that we've seen. I've actually heard more folks talk about, the need to get a new shop because of what they're thinking about on their maintenance plans. And as somebody who's done a lot of maintenance work in the mining industry, like sometimes that can be one of the best investments that you make, even though, some people might talk some crap because, it's a downturn and you're buying, you're building a new shop. And it's, a lot of these things are, again, what are the numbers behind it and how does it fit your overall integrated plan? Shay, we talked a little bit on the procurement size out there. Can you just like quick give a little bit more of a breakdown of like what are we actually talking about here? And like
So
this idea of minimum viable scale.
yeah, so on the procurement side, all of you know that there are scales of maximum discounts, and then there's the hidden maximum discounts, and then there's the bottom line price, and those are at different scales. I would say you start gaining some of those efficiencies at about 2,000, 2,500 acres, which is, Ben, you and I have talked about this many times, maybe that minimum viable scale moving forward. And I don't want people to, there might be many of you on this call that are farming 800 acres or 1,500 acres. It's not saying you're not going to have an opportunity. It's saying you can look at scale, you can look at niche markets, you can look at where you can maximize efficiencies with the machines that you have in order to be viable at that scale, but you have to think about it pretty seriously. So I would say 2,500 acres, 5,000 acres, 4,500 to 5,000 acres is where we start seeing some of the large efficiencies from input cost or bulk purchases or procurement. And then beyond that, it's anywhere in that 12 to 15,000 acre range that you start seeing I guess what I would call maximum discounts, maximum efficiencies from an input side on procurement. However, I would say on the back end or the flip side of procurement is the sales side. And you can think about this a bit more strategically, even as a smaller operation, of what are you offering to your end user? And many people don't think of their grain merchandiser as their customer. I'm the farmer, I'm the customer, you're buying my product. You need to think about it the other way and say, okay, the grain merchandiser is my customer. I'm coming to them with not 5,000 bushels. I'm coming to them with 100,000 bushels of sales, and I can offer a different delivery period, or I can offer to hold it until later. Can I get a basis pushes? Excuse me, a basis push? Can I get an opportunity to pick up some carry in the market, or are they saying, well, if you're going to give us this 100,000 bushels, we can offer you some trucking incentives? There's a lot that goes into that on the back end that you can think about at a smaller scale. So all of these principles are applicable, but those are the acreage amounts that I would say.
Hey Shay, we got a good question. Like I love this one because it is direct and to the point, and that is what we very much like. I'm a 1,000 acre, and you kind of answered this, but let's just like double click on it a little bit. Like I'm a 1,000 acre farmer, and if minimum viable scale is 4,000 acres, it's and I think we're about to literally talk about how much cash that is. Like, does this mean that I'm just like at a massive disadvantage? How should I think about it? I'm
Yeah,
paraphrasing.
so again, you can get niche or you can scale. And if you have the opportunity to scale to a minimum viable scale, either through capital allocation through something like what Fractal is offering, or if you can look at the opportunity to go out and rent ground and be aggressive, or look at opportunities. I'm not saying that those operations aren't going to exist. This is just our overarching look of where we've seen people be successful and where I think it's trending in the future. And you don't have to like that, but I would say you have to seriously consider what that looks like. And if you're a 1,000 acre operation and you're all owned land and you want to, run older equipment and be that low cost producer that maximizes efficiencies, it's probably okay.
Yeah, I think the other thing that I've heard from you and Chris quite a bit that has really opened my eyes in the last even 3-4 months, collaborations.
Mhm.
Especially when we talk about equipment or grain storage handling efficiencies, as long as you can get to, I know it takes a lot of work to like structure those collaborations, but if you can get there, I think there's a lot of opportunity for those folks. Maybe the other one that I've seen that's been interesting to your rental point is I'm not going to make value judgments on where folks sit. I would say that I have seen mid-size or smaller operations, if they can handle it and they're prepared and they are very, very clear with some of their neighbors that they are looking to grow and continue the farm, uh, turn collaborations into really good rental opportunities. And I've especially seen this where there's been a generational transition or they're in that kind of process. And you see that kind of maybe a little bit more hunger and risk because somebody knows they have 20, 30, 40 years ahead of them of farming. That's when I get pretty excited about some really strong operators being able to have the scale to match maybe their management capacity.
And I would say people think of collaboration and transition planning in two separate buckets, and they're not mutually exclusive. So, to your point, if you can collaborate with someone that is maybe looking to retire in 10 years, that collaboration is a transition plan for that senior partner. And we have seen that be highly effective. But it goes back to, again, you have to have a legitimate plan in place and you have to target it strategically. Don't just say, oh, well, if the opportunity comes, like go seek those opportunities. Because if you're not, I guarantee there's a better businessman that is and is going to take advantage of that.
Yep. So Harrison, maybe let's go away from the slides here for a second, and we're going to start walking through an exercise that and we're going to do kind of the fake whatever you want to call your fake farm, Shay,
Yep.
you built out in Profit Manager and go through. And this is something that I know I'm seeing a few names in the participants. This will be the abbreviated version, and it'll be a little less fun than the spicy conversations we usually have. On that. But what we typically do when we sit down is we like to go back essentially through that list that we just had. And what I want to lay out with Shay here for this farm, we've kind of combined a couple of folks that we both know into this is what are some of the opportunities on the table, and then let's go how to think through it and do a little bit of actual mapping. So Shay, what's the size of your farm?
We'll call it 2,000 acres.
Cool. We'll just say Central Illinois since you know that market a little.
Yep. Yep. And were you wanting to share your screen on this, Ben?
Yep, I will here.
Okay. So this is the Ben Gordon Farms, by the way. I decided that's what we're going to name it.
Perfect.
Call it BG Farms.
Yep, very it'll be a little less efficient than
You're a real farmer now.
great. So in this as we go through, one of the first questions I'll typically ask somebody, if we've kind of aligned at a high level is, how many more acres could you farm? So you're a 2,000 acre farmer today. How many more acres could you farm with your existing land and equipment?
Let's say 500 acres.
Okay. And I know you're going to go through a exercise. So I'm going to assume your neck of the woods, what's the dollar per tillable?
15,000.
15. Okay. All right. So that means that we have about 7.5 million of total assets that we could farm, but we know that we can finance and that we can rent typically. Loan to value is roughly 50% your bank today.
Yep. Yep.
Okay.
That's fine.
So that means we're at about 3.75. I'm just going to give us a range here. So you don't know. I mean, I think we would obviously love for you to get a landlord that, or maybe it's a retiring farmer on these 500 acres that you could get a first right of refusal or a long-term lease on. But we know that doesn't come up every day. And so I'm going to let's maybe talk about a range of how much we'd want to rent versus how much we want to own.
But
So I'm just going to go 25 to 75% rented
yep.
on there. So that math means just on the new ground that we want to cover, that we're just under 1 million to about 2.8 million. in terms of capital that we.
And I think that's a fair estimate too for many of you thinking about that. If you're picking up 500 acres and you're able to purchase 120 of that, that's roughly what, we're talking about versus, a lot of people would look at that and say, well, I may not be able to buy 380. So, somewhere in the middle there is good.
Okay. Yes, I mean, even if we did this, if it was 50%, obviously that's just double. We kind of know what our range is at.
Yep.
So if that's like the lowest hanging fruit and we have on the land side, anything else? So think of the actual customer that we're talking about. Like, what do we think they need either in that expansion or just in general? Where does storage fit? Like,
Yeah, I mean, if you're adding 500 acres, you're going to have another, 150,000 bushels of corn. So let's say they're going to need to put up 120,000 or 100,000. That I think that 350 that you had in there is probably actually pretty accurate.
okay. Any other projects you think we should think about here?
No, I think someone going to add 500 acres from 2,000 to 2,500 probably has the other infrastructure outside of storage.
Okay. So what I'm going to do here is I'm just going to. So we're just trying to do this live. Like literally, I'll usually do this on a pen and paper with somebody. And I'm going to call this our offensive strategy. So this is the stuff that we'd be looking to pick up. We have a range of, I'm going to say low, high. I have a range of 1.3 to 3.187. So that's great on the offensive. Have we gone through and done our landlord exercise yet? I don't think so. So let's think through and just like sit there of the landlords we have today. You're about half owned, half rented. How many of those do you think could come up for sale? I know you don't have a perfect idea, but like how many could come up for sale in the
Yeah,
next 12 months?
let's say 300 acres.
Oof, I don't like when I hear that.
No, but I think there's a lot of risk out there that people are looking at right now with these inflated land price, and I shouldn't even say inflated, with strong land prices, um, that you have generations that are in that transition phase of do we let the next generation manage it or do we sell?
So I'm because I don't want to just like cherry pick if people are looking at this being like, oh, this guy's just trying to like put a false number up there. I'm gonna assume that you have a rich dentist in town who you really like and you trust deeply because you've been drinking beer with him or her for a really long time. So I'm gonna say that you're only gonna need to buy half that and he'll buy the other half and you feel good.
Okay.
So now we're at another $1 million. So D40. So you notice we're just doing this right on the fly because every one of these spreadsheets ends up looking different.
Yep.
So, and when I put these capital numbers, this is after financing. Just a reminder on this. These numbers are essentially double in size, like with the bank. And so I'm going to come at this just from a capital availability standpoint. We're not even going to talk about debt service coverage today. That's a slightly more detailed analysis. It's really not that hard. You're just going to take whatever your net operating cash flows are, and then you're going to take the debt service from that, depending on how your banker underwrites kind of the future. In other words, do they
Mhm.
underwrite an advantage to the operation? I've found that bankers don't really believe in many forward-looking things. So it means that when you get these margin improvements, you really need a couple of years for them to bank them, and then they actually get credited, if you will, through your next year's balance sheet. And
Yeah, I would re-emphasize that typically they're not going to give you any advantage.
so you are a 2,000-acre farm today, Shay. How much working capital would you be willing to part with, do you think, to go fund these investments?
Maybe $150 an acre.
Okay, so we're gonna say what do we say, like 350K,
Yeah.
350? We'll say 500 just to be good on that. And so what that really means is we are looking at an equity gap of 1.86 to 3.7 million that we probably want to go through. And we have a couple of options on there, and I think we'll come back to those options on where they fit. But if that's kind of the what we have right in front of us, I guess the real question to come back to is why the hell are we trying to spend all this money? on here and where this goes, where does that fit back into our operation? Because if I just like went through that exercise, like, yes, growth, it feels good. Where's everything at? Now, this is the point in the conversation where a lot of times, even super smart folks who've literally done this before and that's how they've gotten their operation where they're at are like, oh shit, what the are we gonna do here? In their heads, they're keeping it safe with
Yeah.
where that goes. Walk us through the analysis and how you guys look at it. Let's say if you're using Profit Manager or you're doing something on the Aggie side.
Yep. So we'll look at just a machine efficiency slide here, and essentially what we're how we calculate our equipment is in this example, you got your implement costs on the left side. So you're running a couple combines and a tractor. The heads that are associated with it, you got $860,000 of total machine value capital tied up in this operation. If you're spreading it over 3,500 acres in this example, and then you go to pick up another 500 acres, that 3,500 acre, your machine cost is about 56 bucks an acre. If you add 500 acres, go ahead and advance here. You take that cost down by about 6 bucks an acre to 4,000 acres. So, $6 an acre. Okay, Shay, that's cool. That's going to give me an extra 25,000, $30,000 of cash flow advantage by going to that. But take that times all the other passes that you do in the operation. So now your sprayer's going over more acres, your planter's going over more acres, your tillage is going over more acres. And people say, well, the labor required to do that. Well, if you got labor enough, like if you're not totally strapped to the teeth on 3,500 acres, you probably have the people in the machinery and the equipment efficiencies to go to 4,000. And that's an objective outlook from the operations that we work with, that if they can make that leap, typically somewhere between 2,200 and 2,800 acres, they're taking the next step in equipment and machinery that gets them to that 4,000 acre efficiency. So you probably have the people and the equipment in place to do that, especially with those machines, or maybe you need to upgrade into one class 8 or class 9 machine in order to make that happen. But you just need to assess what that capital outlook is on the machinery in order to maximize that machine efficiency. So, we're talking 500 acres here. Again, this is a few more base acres than what we just ran in our scenario, but the math is the same conceptually. And actually, that 2,000 to 2,500 acres is going to have a larger impact because you're adding 25% of an acreage base as opposed to 12% like we have annotated here. So you might take that cost per acre from 68 or $70 an acre in your combine pass down to 58 or 60. So it's having a larger impact on a per pass basis. I would say that the machine efficiency on top of that land purchase, you're going to be looking anywhere from 30 to $40 an acre just in equipment efficiency gains by taking on those additional acres. Like you said, the bank probably is not going to give you that advantage right away, but you know it to be true.
I think one of the coolest, we were with Jeremy Dutch on the AgView team, and we were playing with his profit manager, and he actually did this exercise for some rented ground that he was looking at, as well as some potential purchases. And it was cool for us to actually like play through right in it and to see it live on where it hit. And all of a sudden we knew like what was that additional kind of benefit that he was playing with. I guess this whole concept is contribution margin. Do you want to do just a quick high level on like contribution margin and just like the conceptual? Um,
Yeah, it's taking your working capital, your assets that you already have, dividing them over more acres and looking at the efficiency that you gain over it. And we'll rip through the next scenario here pretty quick, but it'll accurately display that contribution margin. So this example that we have is going from 2,000 to 4,000 acres. These are numbers from an actual, I'd call it client mock operation, blended numbers that we kind of took from our clients and plugged in. So initially, in today's environment, we're looking at about a 4.8 to 5% loss for a 2,000 acre operation. When you start plugging in some of these efficiencies, we're going to see about a 20% margin swing here. And this is including the extra expense. So the margin is going to go from 15.7, from minus 4.8 to up to 15.7% return in the positive. Now you'll notice as I run these scenarios, I actually increased your land cost, assuming that you're going to have some higher rented acres or some owned cost in there from 335 up to 350. Your return to management is a decrease in cost because you're spreading it over more acres. I doubled the interest cost, which,
Hey
someone.
Shay, what's return to management for those that?
Yeah, good question. So return to management is going to include what does the farm pay for? So that's going to be everything from your principal and interest payments on infrastructure, if you're not including that in your storage cost down below, to what do you pay yourself? Do you accidentally go out and buy a boat that the farm has to pay for? Your return to management is like all of these expenses that are calculated in on a per acre basis. What's your draw from the operation essentially? Um, and for these purposes, that 140,000 would just be primarily your draw because we have the other ones included.
Mhm.
And then, you start looking at the efficiencies. I took your seed cost down about $20 an acre, fertilizer and lime down, assuming bulk purchases and procurement, and nitrogen down about 10 or $15 an acre. Those are real numbers, by the way. I mean, I ran a fertilizer survey here the other day. The list price is different than the delivered price when you start talking some of these larger operations, and these are real efficiencies. So let's go to the next slide here. Again, looking at that 4.8% loss, go ahead and advance. On the equipment, you spread out, you go from $30 an acre on the strip till down to 18, 15 on the sprayer down to 9, planters 22 to 16, decrease in the drill cross if you're doing cover crops, and then, mid 50s or 60s on your harvest efficiency. At the bottom left there, you'll see your cost per bushel at 42 cents per bushel on equipment. That's the way to think about it because it's how many bushels is that equipment servicing. If you go from 64 cents a bushel to 42 cents a bushel, you know, I screw up my marketing every day, but typically, hopefully not 22 cents a bushel. So that equipment efficiency is huge. Let's go ahead and advance one more here. We'll look at, the margin again from a minus 4.8% loss. This is the back end sales that I was talking about. You go from 438, maybe you're getting a basis push, maybe you're getting carry, maybe you're getting reduced trucking costs. Go ahead and advance. Better basis, better storage, better drying. You might get an average of 468, and we do truly see swings of 30 to 50 cents for operations at scale that are doing their marketing appropriately. To wrap this up on the next slide, all these changes included, you're going from that 4.8% loss, needing 240 bushels an acre, to now you're at a net margin of 15.7%, and your cost of production base bushels is 200 bushels an acre. By the way, your expenses went from 2 million to 3.7 million, but you increased your profitability so much on the back end due to procurement, due to basis, due to equipment efficiencies. Cut that number in half. You're still at massive margin gains.
So that's insane if you're not familiar with the economics of where that fits in a commodity business, like a low margin business. And this is, I'm not even talking about agro, I'm just any commodity business. To see those margin swings is not normal. And I think this is what we're talking about when we say competition is increasing and like the need to go out there and get at this. But it also is a very positive thing, I would say, in that there is a lot of opportunity out there for those that are able to seize it and kind of make it happen.
My
With
final comment on this, Ben, and you and I have been talking about it. We were on with Damian Mason, Business of Agriculture podcast the other day. We are very fractionalized today compared to the rest of the world, or like when you look at Brazil or whatever. The opportunity, the squeeze that you're feeling is for this
Mhm.
exact reason right here, because there is a lot left to squeeze from a commodity production standpoint, whether you like it or not. This is what commodities do, and commodities are going to continue to do this.
Yep. But yeah, I'm still gonna take. And I know it's really easy for me to sit there in the investor seat and say this, but I guess when I look at the farms we're able to work with, and I see the opportunity that's on the horizon for them, and especially when they are being proactive and they can use things like collaboration, even if they're at a slightly larger scale, to be able to see those savings and like the ability for that next gen to come back and build a damn good enduring business. That's not just walking on that razor wire edge. Like that is a pretty important thing. But we know there's a lot of risk in how you get there. We just got a really good question. Really good question. These are actually two of them that I think are a really good jump. Let's actually start with the smaller one. Craig, what Craig asked: farms looking to scale up and invest capital. There's obviously a lot of different areas where capital can be spent that we've spoken about. Um, where should they spend it first? Buy acres, rent acres, machinery upgrades, grain storage, field improvements, input storage. Where do you go, Shay? How do you answer that?
I would say, what are your long-term needs and where is your base at today? If you're low owned acres and you want to create some security and long-term base in your operations with balance sheet improvements, it's probably going after some owned land. We work with a lot of operations, and it leads into the second question of, adding 2,000 acres seems like a lot. How do you manage that? We work with a lot of operations that are like 4,000, 6,000, 8,000 acres that have almost no owned land. That is a massive, massive risk when you're looking at operations that have very little collateral other than their operating or free cash flow from a working capital position. So I would say, if you have a low owned land base, you should probably look at some land procurement. Um, and again, if you're not at the equipment efficiency scale, that's a great place to start. From how do you take advantage of that margin contribution and spread it over more acres?
Yeah, and I think I'm the ex-consultant, so I was going to say it depends, and it always depends on like where the opportunities sit. And I think the important thing is understanding like what are the biggest levers overall. So if you're subscale on storage or you're overbuilt on machinery, how do you balance those things out? Is it owned? Is it rented? Especially the right type of rented or collaboration to go out and get there. And this kind of leads to that next question, which is like, all right. 2,000 acres, that's a lot. And we haven't even gone back to the spreadsheet to look through like what that math looks like. Holy cow, like what like how do I even start going after those things? And I'd say like the first piece is really just being prepared for those. And like that's a really blanket statement, but I think it is what can your bank support today? What can another capital provider, whether it's Fractal or your investor dentist friend or somewhere else, like go out and look at all your options that are out there. And then where are your systems at? Understanding the two or three like the biggest things you need to do on your business systems example to pick that up. Like, is it going to be another employee? Is it going to be X, Y, Z? Like, where do you have that flexibility? I guess how do you think about it, Shay? I guess anything that I'm missing, just kind of in that high level.
The systems is huge. What's your bottleneck? I mean, if you're, yeah, going from 2,000 to 4,000 acres might be a problem if you need to store all your grain, but if you're taking it all to town anyways, and it's adding a couple more good quality employees as truck drivers and adding a little bit more infrastructure from a capital investment standpoint into hauling, that's probably not as big of a deal. I would say logistics comes into that major. The the capital is sometimes, there's a ton of solutions out there. So whether it's like working with Fractal or even if it's through your traditional lending, and you can put good cash flows in front of them, good projections, good business decision on, hey, yeah, I'm going to jump 2,000 acres, but I'll tell you what, Mr. Lender, I'm going to go ahead and pre-sell 50% of my grain tomorrow. Or I have the ability to go in and do that today. That's part of my marketing plan. That's the security guarantee that I'm going to give you and to get that deal done, then that gives them a lot of opportunity to take advantage of that. So it's just being methodical about how you analyze those systems.
So I want to come back to our exercise. And again, this was just these low and highs were just our offensive and defensive. It was just that 500 acres and the potential for 300, and this is where we needed to be ready at. If we were to go and look and we said we wanted to expand that 2,000, we're probably not going to do it all at once, and it's not going to be all owned, right? So let's say that we're going to use that same 25% to 75%. Like that's another 3.5 million to 10.5 million. And so when I'm sitting as a farmer and I'm thinking about those different capital providers, like this is the exercise that I would encourage all of you to do and like run your couple of different scenarios. And like this is just a sheet I literally did 15 minutes before this and like happy to like work through with people because what I want people to understand is just what are the bounds of like kind of where you have this ambition in your head, like what are those capital needs going to be? We haven't even included things like additional working capital you would need, making sure your bank would be ready to go on that. So you're and like liquidity. So that way we're not making dumb grain marketing decisions because we're capital constrained at a point in the year. So I guess it's not dumb, it's being forced into it. This is where there's a really, really important exercise around just understanding the reality that sits in front. My pitch, Harrison, if you want to throw the slides back up, just from a fractal standpoint or other investors that I want folks to understand. We will do, so Shay was giving me crap because we got some feedback at the last one, like what does fractal actually do? We will do a much deeper dive, Shay. I promise I will do this so you don't have to answer questions on my behalf with random people on it. But we will do a much deeper dive on exactly how fractal works and where that fits. But a couple things that we're really trying to do is one, when you access your equity, if you're using debt, it's going to be a lot more expensive. We're essentially 66% more capital for the exact same payment. So we help you expand out a lot faster with those same cash flows, and we lock up less acres because we're taking a second to the bank, and so we're not just getting you in a cross-collateralized mess that's all out there. The third one is one of the biggest things that we built in. None of us can predict the market on these cycles, so we share risk and reward. We're more expensive than debt, but we also are cheaper when land is cheaper. And we know land is driven by operating profits. Our whole idea here is you get to win twice with that expansion. You win on the operating business, and you're going to win just as much on the real estate business because you'll be over almost twice as many acres, or 66% more acres on that. And then the last thing, ownership and control. We lock the investor in for 10 years. We're trying to not play the cycle. We're trying to get access to the best operators and the best land over time. And we maintain farmer control agronomically and where that fits in. And so really think of us as a complement to the bank, or in a market like this, probably a little bit of a substitute where you want to just go further and take advantage of these big opportunities. And the ask I have to anyone is like, hey, go through this capital planning exercise. I think Harrison just put up the poll question. We're happy to go through and actually just walk through this with you on it. If you want to do a much deeper one in terms of all the other things beyond capital, there's a lot of players out there, just like there's other capital providers out there. Talk to Shay, talk to his team about a consultation, what they can do. Take a look at that if it's a fit. Find your farm team to be able to have these conversations. Because I'd say if you're not having these conversations right now, you're going to put yourself in a pretty tough situation to be able to get onto that growth snowball and get going. If you're already on that growth snowball, how do you take that even further to go build a generational business that creates even more defensibility and where you're at, especially if you're planning on bringing two or three of the next generation back? What is that going to look like? Like I said, we'll go deeper on where this fits, can explain like how it works, but really the big thing that I really wanted to emphasize was just, we're trying to help take those cash flows further, shared risk, and then be prepared, not just with us, but with other folks out there. I know we got 1 minute left. Jay, what are closing thoughts overall? What have we missed?
Yeah, Harrison, if you would go to the last slide here, I would say my closing thoughts are you have to be methodical with these decisions. You have to use tools. You have to have a plan in place. And even if you're not planning to do anything right now, conceptually, you need to understand what the implications are for your farm operation. And so uh, AgView Solutions is not tied in with Fractal. We just are aligned on how we think about business strategy and management moving forward. And so I put this slide together. I said, why Fractal? Why now? And hopefully you guys have realized like the amount of capital it's going to take to realize this growth is you're not going to pull it out of nowhere. You need to have a legitimate plan. So this last slide just emphasizes, use your assumptions. Don't take our word for it. Don't just look at historical context. And the numbers we have plugged in here is in 2000, the year 2000, the average land price in Iowa was about $1,850 an acre. By year 2025, here today, average land price is just under 11,500. If that's 7,000 or 7.55% appreciation is projected forward, that makes land cost 70,000 an acre in 2050. And that's just math. I don't care whether you like it or not. But if you say, well, Shay, that's not going to happen, we're going to have these ebbs and flows and the land's going to crash. And okay, well, plug in what you think the appreciation rate is. Is it CPI? Is it 2.9 to 3.5%? If that's the case, land is still 27 to 30,000 by the year 2050. What does your investment look like today from a balance sheet appreciation over the next 25 to 30 years by going in and making capital purchases, investing in your infrastructure, purchasing land, whatever it is that you need in your business? And that's the take home message. You got to have a plan in place. You got to run through these exercises, hop on with Ben, have that conversation. If you want to work with us, give us a call. And that's what we didn't put up here, Ben, to follow up if people want to reach out to us. My email is shay@agviewsolutions.com. You can give me a call, and of course, you can reach out to the Fractal team however you want them to do that, Ben.
Yeah. We'll grab it from the poll, or it's ben@fractal.ag, and then we'll send a follow-up out of this. I think the only other thing I would ask of folks is just, was this helpful feedback? What did you like? What did you not like? And what would you want to see? Whether that's kind of view on land values, where it's going a deeper dive on opportunity mapping, other analyses you'd want to see, just let us know. We did this a little informally just because we were trying to capture what we heard from a lot of our in-person conversations. So we'll keep iterating and keep trying to share more and more of these tools if they're helpful. If not, we got plenty of other stuff to do. So our one ask on this is let us know. So with that, I think we'll wrap it up. Shay, thanks for joining, and thanks for everyone for attending. And I hope as harvest has either started or is starting, that conditions are all right, especially given I don't think everything looks as good in terms of field loss as the last couple of years. So hopefully the markets will recognize that too.
Thanks, Ben.
All right. See you guys.